Is a falling stock a sale or is it just a sign of things to come? Thanks for joining my channel. This is Discovering My Dividends. There's a dividend growth stock right now that has got my attention. That stock is ATD, Alimentation Couche-Tard. Now, I don't know if I'm pronouncing that properly, but it's ATD and it's on the Canadian Stock Exchange. So what they do is they're convenience stores and gas stations, and they're global. They're worldwide, and they do acquisitions worldwide. So if you're looking for dividend stocks, which is what this channel is all about, well, their dividend is typically below 1%. They have increased this dividend consistently over the last 5 to 10 years, and there's been a 5 to 10% dividend growth rate during that time. The payout ratio is between 15 and 20%, which is well below 60%, which is kind of the bar for, if your payout ratio is below 60%, you're probably going to be able to maintain your dividend payout that you're doing. But if it's above that, probably not. So quite a bit below 60 means there's lots of room for them to grow this dividend that they're currently at right now. So some of the positives are they are expanding through acquisitions globally, low debt to equity ratio with strong free cash flow. This business is somewhat resistant to recessions, cycles, or downturns. So is this growth or is it a dividend yield stock? And where does it fit into this? So definitely more of a growth stock with a low payout ratio. There is room for dividend growth, but there's a strong desire to grow through acquisitions. This creates a focus on growth over yield. Currently, ATD is pursuing the 7-Eleven chain through acquisitions and potentially using debt for the purchase. So some other stats that you may want to kind of consider if you're looking at ATD, the price per earnings ratio is 15 to 18, so not considered overvalued. The price per book is sitting between 3 and 4, so typically not overpriced for assets and not overpriced relative to revenue based on the price per sale, which is less than 1. The return on equity, 20% plus, so very strong indicator of profit generation. Debt to EBITDA, around 2, showing manageable debt levels. And so with all those extra stats kind of leading to the fact that this stock generally is not considered overpriced, but they're pursuing growth. For a long-term investor, this may be good. So some of the red flags you may want to also consider before jumping into this stock are this may not be for individuals looking for high returns in the short term. Obviously, with a low yield percentage, you're looking for growth and hopefully a long-term dividend yield increase. Acquisitions may have hidden risks, and for a company that is pursuing acquisitions and globally, is their platform going to be able to be expanded into these areas, or how's that going to work out? And you know, acquisitions do always have some kind of question marks around them. Finally, how will EVs affect fuel sales and profits? EVs are coming, they're here. And how much of the fuel market are they going to take over? Is it totally going to be taken over, or is it only partially? How's it going to affect companies who sell fuel retail? And is the profit margin still going to be there? Is it going to increase, decrease, or is it going to disappear altogether? So this is a question maybe a lot further down the road, but it might be closer than we think as well. And that may have some impact on whether or not you choose this stock. Now, for those of you who are looking for a new broker or just starting out, I use WealthSimple. I don't pay any fees on any of my Canadian purchases, and they may change that in the future, but for right now, they don't. Now, I'm not sponsored by WealthSimple, but I really like them, and I think it's an easy platform to use. I do have a link below. If you use my link, we both get the same reward. If you use somebody else, just make sure that whatever you're picking, you're paying the least amount of fees you can and something that's easy to use. When you're starting out, that is probably the thing that I wish I had known when I was starting. So my conclusion on ADT is, well, I'm going to jump in here. I like that the price is dropping right now, and it's kind of had a little bit of a turnaround. They previously had a drop when they tried to acquire a French convenience store chain. And so what happened there is their price dropped, the sale didn't actually go through, but then their price started rising again as things started turning around. Right now they're pursuing 7-Eleven, and that may have affected the price. And of course, some of the talk around it is they're going to use more debt to do this as opposed to the cash flow they have. But they also are going to be able to generate a lot of cash with their current uh, earnings right now before that actually comes through. So how much they're going to be using for debt is yet to be seen. And based on what the company is saying, they feel like that they're going to have a strong enough position to be able to pay off that debt relatively easily. Now, whether or not this actually comes through like that or not, I think recent history shows investors get concerned when a company like this goes out and is doing an acquisition. And so there's all kinds of people jumping out because they don't know what's going to happen. It changes what the future might be. On the other hand, there's people like myself who start to go, does this mean that's going to grow what their potential sales are, their potential profits are, their potential dividend in the future? So, right now, am I getting a sale on what their potential profits could be and what my potential earnings could be off of what I'm buying? So, this is for me a future consideration, and it's something I'm willing to get in a small part based on the fact that the price has come down. And in the past, when this has happened, they've also bounced back. So I'm looking at that as a potential turnaround, although I am not an expert. So I'll give you my disclaimer right now. I'm not an advisor. So if you use this information for your own portfolio, do your own research or go see a professional advisor for advice. Make sure that this fits in for your portfolio or what you're doing and you're not risking more than you can actually handle. All right, so that's it for today. I hope you'll join me for my next review on discovering my dividends, and we'll see you next time. Have a great day.